Cisco is a New Hampshire.
Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Anderson. Tom is currently the President and Chief Executive Officer for the Retirement Industry Trust Association.
Exactly.
RITA. And he is also a director and a founder, past president and CEO, past CEO, I guess I should say, of Pensco Trust. Pensco Trust is a New Hampshire-based bank and trust company.
That's right.
And they are a custodian for self-directed retirement accounts. Tom grew up in New York and in 1969 started working at Hartford National Bank, where he became the head of systems development and strategic planning. In 1981, he came to Bank of America in California, where he became head of trust systems development and trust and stock transfer data processing. In 1989, he co-founded Pensco Trust. Tom has testified to the Department of Labor and the IRS about individual retirement accounts, or IRAs, instigating changes to the IRS regulations governing IRAs specifically related to the capital requirements for any company offering IRA services. He was invited to Washington, D.C. in March 2009 to participate in an elite group called the Future Finance Initiative to make recommendations about the future of banking in the United States. Today we're going to be talking about alternative investments besides real estate in your IRA or Roth account. We previously discussed real estate, and you can find that interview under past episodes at www.financialinsiderweekly.com. Before we get started, I want to caution our viewers that we are discussing issues in a very complex area. This is a starting point for a bigger discussion, and so we want you to get qualified legal and tax advice. Tom, thanks so much for joining me.
It's my pleasure, Michael.
Okay. So to get our viewers up to speed a little bit again, why did you get into this area of offering independent trust services for IRAs?
Well, basically, my experience as a consultant, I found that the firms that were in the business weren't performing extremely well, and part of that was because they lacked the proper systems, and my background in trust and investment systems led me to believe that I could do a much better job, and that's why I started Pensco.
Okay. And now you're involved with this Retirement Industry Trust Association. You had a little change happen, and you.
Well, I wanted to take some time off and retire from full-time 70 hours a week, and starting to enjoy my retirement. And then I started to participate in the Industry Association of Self-Directed Custodians, and I'm on my second term now. I got reelected as president. And now I'm partially retired. It's becoming as the industry association grows, it's becoming more and more of a day-to-day thing. So,
can you tell us a little bit about what the Retirement Industry Trust Association does?
Well, essentially, we develop best practices in the industry, and we try to. We have now a new IRA Institute that we created, and we have a certification program, Self-Directed Industry Professional. So we offer that to the public and to our membership so that we can raise the bar, if you will, in terms of knowledge and expertise in our industry. And we just launched that this year. We also are able to lobby, if you will, and interact with government officials who are involved with retirement issues more effectively as an organization, as opposed to individual firms trying to do that on their own. So we have very good dialogue now with all the regulators. We've recently, over the last 2 years, met with the SEC, the National Association of Securities Administrators, which is the state securities regulators. the FBI, and we've actually given materials to these agencies to help them deal with some of the issues they deal with on the fraudulent side, because with the downturn in the economy, there's fraud in all areas and starting to be affecting our industry as well. So we're collaborating with them. We have a very effective relationship with all the regulators. So it's a vehicle to enable these kinds of interactions with key players in the retirement sector.
Good. Okay, now before we sally forth in this area of alternative investments, you mentioned to me before we got started, there's a couple of developments that have been happening that people might have an interest in. One has to do with some interest by the Department of Labor on the definition of a fiduciary or something like that?
There's an individual who heads the Employee Benefit Securities Administration. Her name is Phyllis Borsey, and she has proposed a change to the 1974 version of the definition of fiduciary, which basically was surrounding giving investment advice. And unless you gave investment advice, and it's very specific types of investment advice under certain conditions, for example, that both parties recognized it as advice and it was more than one time, things like that, you wouldn't be deemed a fiduciary for investment reasons. She's proposing expanding that dramatically, including self-directed custodians who give no advice at all, purport to give no advice in all their documentation, have never been found to give advice in any court cases, merely for the reason of evaluating, or not evaluating, but valuing alternative assets or reporting alternative assets on Form 5498, which is the form that goes to the IRS. So for the reasons of just doing those ministerial functions, this proposal would deem us to be fiduciaries. However, we were one of about 200 organizations and individual firms that testified to the Department of Labor, to Phyllis Borsey and a panel. Actually, I met with Phyllis with two of my associates for an hour to discuss our issues, and we're confident that the service providers like self-directed custodians will no longer be considered fiduciaries under the revised changes. In fact, there was bipartisan Congress support against the proposal as it stood. So they're working on it, and they expect to have something out by mid next year. I actually planned to meet with Mrs. Borsey, and she's going to speak with our group at our conference in March in Washington. So we want to revisit where they stand on that issue. The other issue is, which affects everybody dealing with alternative assets, and therefore affects anybody with a self-directed IRA that's going to do anything other than stock, bond, or mutual fund. And that is the issue valuing annually alternative assets. Because of the Madoff situation and Dodd-Frank, which reacted to it, there's pressure now to require all holders of alternative assets, including IRA custodians, to value on a higher standard all alternative assets on an annual basis, and to the standard that would be required from a fiduciary firm that does nothing but valuations.
Uh-oh. That sounds expensive.
Yeah, exactly. The result would be just like when they're trying to spend more money in government, it eventually comes out of the pocket of the taxpayer because somebody has to pay for it, and that's where the money comes from. So if we end up having to be fiduciaries or deemed to be fiduciaries, the cost of compliance, insurance, education, all that we would incur, plus the performance of the valuation process itself would result in additional fees to the client in order for us to stay even. So we're, for the purposes of helping our clients and giving them the option to decide to what level they want to value assets while they're being held, we're trying to fight against that. However, we do have an understanding informally with the IRS, who really governs IRAs, not the DOL, that unless there is a taxable event like a distribution or a conversion to a Roth from a traditional IRA, which results in taxes, that we won't require a full third-party qualified evaluation. We will do a best efforts valuation, which is a lot less expensive.
Yeah. So this is a really huge issue. I've written, we'll talk about my book later, but basically a chapter related to it. And particularly when people get into retirement age, and we're getting more and more people that are there. So once you're 70 and a half, you have to start taking distributions. And the way that you compute your distributions is you take the value of the account at the beginning of the year and you divide it by your life expectancy or some factor, if it's an inherited account or something like that. And so that valuation, becomes a pretty critical number. It is important, but the problem is that if you have to do a valuation on these alternative assets each year, you could have a big bill. I think corporate valuations I've seen start at $5,000 or so.
Well, the thing here is that first of all, if you don't have the majority of your account associated with alternative assets and you have available cash, you don't have to actually distribute that assets. It does come into play in terms of being a part of the overall value of the account. But if it's a small percentage, the amount that might vary in terms of a 1/20th distribution over your expected lifetime is very de minimis, and it's not likely that the Department of Labor nor the IRS would go after you for something like that. However, if you're foolish enough to have 100% of your pension plan or your IRA holding alternative assets, which we would never recommend at that age, then you got a big problem, because you're going to be required to do a qualified appraisal of that asset every year, which quite frankly could cost you more than the amount of the distribution. Yeah. So it's an issue, and we try to educate our investors to plan for that eventuality. That is, if you're holding the alternative asset, start to reduce the amount that you hold or even eliminate it by the time you get to 70 and a half.
Okay, so that's the thought, big point anyway for people to be aware of here. Probably worthwhile watching this interview just for that. So let's move along then and start to drift into this area of the alternatives and so forth. And I guess starting with talking a little bit about self-directed IRAs themselves. Why would someone consider the alternative of having a self-directed IRA with an independent trustee?
Well, first of all, if you don't work with an independent trustee, you're unlikely to be able to dabble in some of the things like real estate or private equities with anything but $500,000 or more. If you're going to work with the traditional broker-dealer firms, you have to have a substantial account for them to even consider alternative assets, and most of them don't deal with them at all. Right. So if you want to get away from the stock market and mutual funds, or you want to just hedge against the downturns in those markets, then you want to incorporate other types of asset classes, and those are considered alternative. Anything that's outside the stock market is called alternative. Okay. So it could be real estate, could be foreign real estate, could be private equity, it could be the fishing rights in the state of Alaska for black cod, it could be cypress trees in Panama, it could be a head of cattle, which we had somebody invest in. It could be just about anything you can think of, other than life insurance, collectibles, and subchapter S stock. You can form a company with an IRA, your own company. You can buy a franchise with an IRA. You can co-invest with your family and friends to buy a restaurant and run a restaurant with your IRA. You'll be subject to unrelated business income tax, but you can still do it, and it's perfectly legal. There's this unlimited array of things that you can do in the alternative asset space. Okay. I'm going to skip some of these. We've got about 15 minutes left. But what kind of retirement accounts are we talking about that people can have handled in this type of an arrangement? Well, essentially anything that's non-ERISA related. That is a typical 401k or a multi-participant plan, whether it be defined benefit or defined contribution plan, or they're going to be subject to ERISA. ERISA is there to protect the individual from the trustee, which generally is the head of a company. And the rules that surround ERISA would pretty much prohibit the use of alternative assets and restrict it significantly. So custodians who specialize in alternative assets are not real interested in handling those types of accounts. So any type of IRA, whether it be a Roth IRA, educational IRA, traditional IRA, SEP IRA, simple IRA, all those types, plus any IRA type that might be in the future, like they're talking about automatic IRA, and any individual plan, like a SEP for only one employee or a man and wife, or a 401k for one person or the person and their spouse. Mm-hmm. Those are not subject to ERISA, and therefore the types of investments are synonymous with what you can do with an IRA.
Right. And when we say IRA, we also, a type of IRA is a Roth IRA.
Absolutely, sure, absolutely. Roth IRA is the best type.
Okay. So you mentioned a few unusual investments. Is there anything else you want to throw out as far as some of the types of things that people can hold in these accounts, or unusual
things
that you've seen?
Some people like tax liens because they're backed by the municipalities and they're pretty much a sure bet. And if you don't get the interest, which is generally quite high from the tax lien, you might end up with the property if they fail to pay the lien. In which case you can spend $2,000 to buy the tax lien and acquire a $300,000 property if the person doesn't pay it off. And we've seen that happen. So tax liens are quite popular. Real estate options, where you have the option to buy or sell a property for a specific amount of time, and you can sell that option or assign it or execute it if things move in your direction. And the best investment that I've ever seen in terms of return was a multi-million-dollar annual return on a $10 real estate option. A person had a Roth IRA with $300. They sent us instructions on a Friday afternoon for the execution of that contract for $10 consideration, along with a purchase offer on the same property. And one of my clerks came to me and said, "What's this? I don't understand. It seems like two conflicting transactions." And they were collapsing this transaction on a single day, so that once the seller signed this contract, then this person was going to sign it for consideration to somebody else that wanted to buy the property. So to make the long story short, the person that they were selling it to was going to buy it for $175,000 more than this person was going to have to pay to execute the option contract. So he moved $175,000 in one day into his IRA, his Roth IRA, for a $10 consideration. And if you divide that out, multiply by 365, on an annual basis, you get a +1,000,000% return. So
there you go.
That's just, and what we see is a lot of people. That person had to be a real estate investor, and it's something they were really good at. And we find people with self-directed IRAs applying whatever skill they have or talent they have or investment expertise to their IRA. So if it's a real estate broker who sees properties all day long and he sees a good deal, he can move on that with his IRA and buy it for his IRA for retirement. Mm-hmm. Or if it's the fellow who bought the 10 head of cattle, you might say, why would anybody buy 10 head of cattle? It's because he was in the cattle business all his life and he knew how to make money with it. So,
right. So I think that's one thing. There are a lot of people who are really in the dark or unfamiliar with things like investing in the stock market, for example. They don't really know what they're doing. But they may have some special expertise, and it may be that even it could result in some tax for the IRA in some cases. May have unrelated business taxable income, something like that. Yeah. But so what?
So what? I always say, if you're making a lot of money, who cares whether you're paying tax? If you make more money after you pay tax than you would otherwise, who cares?
So the point is that, again, or a point, that the money is in these retirement accounts for many people. Most of us don't have very much in our personal checking accounts. And if you look to see where the funds that we have are available, they're inside of a retirement account someplace.
Absolutely. It's particularly with the boomers now who are retiring at the rate of $10,000 a day. They're leaving their employ with at least several $100,000 over a 25-year career. So.
Yeah. So what kinds of investments are particularly well suited to hold in an IRA or a Roth account?
Well, passive investments like private equity, for example, you can't get a firm like a Fidelity or Merrill Lynch or Schwab interested in your $10,000 or $5,000 startup investment. Mm-hmm. They're just not going to go through the hoops and the paperwork to enable that. But with our self-directed custodians industry, we will take that investment. And our greatest success at Penske was somebody starting a Silicon Valley firm with an $1,800 Roth in '99 that's now worth several hundreds of millions of dollars in a Roth IRA. And this person now is in their 40s, so it's very likely it'll be in the billions by the time they get to 59 and a half. They'll never pay tax on any of the capital gains.
Isn't that exciting?
Yep.
Wow. Okay. What about private money mortgages?
Well, private money mortgages are a little bit like hedge funds and a little bit like Madoff. You got to be careful because they're not as transparent. You're basically putting your money into an entity that somebody else is managing, and you need to pay attention to it and make sure you know the principles and do your due diligence to find out who's running it, what their track record is, and what their experience is. I've seen private offerings where somebody's engaging into an area where they have no demonstrated expertise, no educational background, and just raising money. And quite frankly, with the Dodd-Frank Act and the passage of the Jobs Act, the regulators are extremely concerned about two new things that are rolling out as a result. One is crowdfunding, which used to be restricted to donations, charitable donations, but now will be investments through the internet into private startups. And they're also relaxing the rules regarding private offerings, which were otherwise called Reg D, and the rules for those were Reg D 501 through 506, and those are going to be obviated by the new Dodd-Frank and Jobs Act, so that people can start soliciting the public without having to file those exemptions. So it's going to be a little bit of the Wild West out there, and not only the custodians, not only the regulators concerned about that, but we as custodians concerned about it because we don't want our clients to be taken advantage of.
Yeah, so whatever that you do, invest in, you still have to use common sense. You still
Absolutely.
have to do your due diligence and see, is this a real deal? Because remember, this is your retirement account, for God's sake.
Exactly. Yeah, while you can have the home run like I described, you also can have a lot of failures. So, private equity is very risky. It's very interesting because you either have a home run or you have a strikeout. You don't have anything in between. You don't get a double. Because of the ratio of the price of stock when you purchase it as a founder or as an early stage investor, and the price when it goes public, it's a matter of 100 or 1,000-fold increase in value. And so if it makes it to the point of going public, you're going to make an awful lot of money. But if it fails and goes to zero in between, you've lost everything. So it's binary, and that's not typical of a lot of investments, including real estate. Real estate doesn't go to zero like Enron does, or or lose 95% value like AIG. It just doesn't. It's a tangible asset. But private equity is 0 to 100. It's like it's on or off.
Okay. For just a moment, what about co-investment? So there are people that maybe want to invest with friends or family members or whatever. What can you do as far as using these?
If there's one co-investment rule, it's called Department of Labor 2000-10A, which basically defines, and it actually was a Madoff investment. That was the case that they were dealing with. Yeah.
Okay.
And his family and stuff. And it said that it provided that you can establish that you could have done this investment without the use of an IRA because you had additional funds and net worth. But you used the IRA because you thought it was a good investment, it was more convenient or whatever, but you still had enough net income or net worth that you could have used other funds, then you are permitted to invest with family members and with friends and family, or any combination, or even strangers and friends and family and any combination. There are some rules about how you go about doing that, and that's, again, one of the things that custodians can help you with. So, for example, if you want to co-invest with your son, but he already owns 100% of the company and it's failing, and you want to bring your IRA into it to help him out, you can't do that because he's a relative of yours and he has 100% ownership. Once the ownership of a related person, otherwise called a disqualified person, is equal to 50% or more, then your IRA cannot participate in it. Now, if that 50% or more is owned by somebody that's not related to you, then you can come in with whatever percentage. Mm-hmm. Ironically, you can also start a company 100% with your IRA, and that 50% rule doesn't apply because there was a case with the tax court and the IRS called the Swanson case that originally was ruled against the taxpayer by the IRS, but then he appealed it to the tax court, and the tax court ruled that since there is no prior ownership with a startup, and therefore there's no 50% rule because nobody owns it, you have zero ownership, that the IRA can actually come in and be 100% of the ownership in that first transaction. However, thereafter, that same IRA, since he owns 100%, he can't bring in more money. So he can bring in other investors, like unrelated parties, but he can't bring in more money from his IRA.
Yeah.
So we understand these rules. We help clients, and that's one of the aspects of the self-directed industry where we don't give investment advice. We help educate people. We have our own set of books in our industry and websites that walk people through this.
That's great. Okay. So anyway, I think the real key, though, for people to understand is there are these possibilities, particularly that if you invest from inception, that you can even invest with people who might otherwise, you might have a prohibited transaction.
Absolutely. Absolutely.
But the thing is can't put any more money in, then you're stuck, and that's what the real
your
hook
wife,
is.
your son, your nephew, your best friend, your neighbor next door could all go in and form a new company at the same time as simultaneous co-founders, or you could buy the restaurant down the block from the guy who's retiring with all your IRA money, or your IRA money and your private funds. You can mix and match that too. However, how that's executed is important. It all has to happen simultaneously in most cases.
Right. Well, we're really out of time. So before we wrap up, folks, I want to let you know I've written a little book. It's called How to Use Roth and IRA Accounts to Provide a Secure Retirement. You can find it at Amazon, Barnes & Noble, and I've got it on Nook and all that stuff. You can even find it at the Apple Store. Oh, boy. So anyway, Tom's looked at it, given me some really good comments that we've included in there. So Tom, thank you for that.
It's my pleasure.
And Tom, thank you for being my guest.
Thank you again.
And we
look forward to coming back.
Great. Folks, hope you've gotten some good information. I know you've gotten some good information today. Let your friends know about it. It's financialinsiderweekly.com. Under past episodes, this episode will be included there. We'll see you next time on Financial Insider Weekly.